the number one explanatory variable that people come up with, other than manipulation, of course, is real interest rates. And since CPI only changes monthly on a day-to-day basis, you look at the benchmark 10-year as a substitute or proxy for real rates. And we have seen just almost like as close to a one-to-one relationship as exists financially. These charts look like mirror images. The 10-year and the price of gold on a day-to-day basis do this Rorschach thing. But in the last week or two, we've started to see that starting to come unglued. And on that particular day, that particular time, it's really striking how you can really see the DXY, the dollar going vertical, and gold tanking at the exact same time. Meanwhile, rates, the 10-year, which has been the most explanatory variable, is just kind of waffling sideways. That is different. And my interpretation of that is that I think the traders, traders, not traitors, though some people see them as the same, on Wall Street in London who trade these futures contracts are starting to really get a clue that, maybe inflation is going to be a little bit more than the powers that be are telling us. And maybe it's not good enough to go with the CPI figures that come out once a month. So you'll have not just the broad expectations, but I think financial players are starting to discount the data they're getting just from nominal rates. And they're starting to factor that in. And what do you do if you can't use the 10-year anymore? What do you plug into your robot, your AI there that trades for you if you can't use the 10-year? Well, I think the next best thing is to go directly to the dollar, and the DXY is data that you can plug in. So we might see more algo trading going directly off the dollar. I would say the latter. We have had the dollar testing that 90 level, which is a multi-year low. And if it breaks significantly below that, a lot of Forex types tell me that will be major. Hadn't done that yet. But another thing, we don't have the chart here, David, but if you look at the nominal 10-year over the last 3 months and gold over the last 3 months, you'll see that it's sort of similar to what we have here, in that the 10-year has pretty much fluctuated with high volatility sideways, hadn't gone anywhere, between 1.6, sometimes up to 1.7, sometimes below. But gold has gone up. It's gone consistently up. The day-to-day movements have mostly reflected the 10-year until recently. But if you look at the bigger picture over the last months, actually you'll see that gold is up substantially while rates haven't really changed. So this fits in the story that I'm beginning to put some credence in, that traders, the people that, not you and I going down to the coin shop and what we pay for gold and silver, but the traders on these futures contracts that set the prices that are most often quoted, are starting to change their metrics. So it's interesting that you picked the 80s. All right, let's take this one piece at a time. If you look at the last 10 years, we say that they've been largely disinflationary. There hadn't been actually any real deflation, but it's been disinflationary, not much inflation to speak of. Yeah. And if you disregard the noise and you look at 1910 or 1905 gold, where we're at as you and I speak, and the peak of 1900, almost 10 years ago in 2011, well, gold's gone sideways. You could argue that gold's gone sideways, inflation's gone sideways, or actually screen out the noise, and they're on par. But the 70s were the most inflationary period since the dollar was divorced from gold in 71 by Tricky Dick Nixon. And the story there, I think, fits in what you're saying. It wasn't so much how much prices went up today that made people run out and buy gold or silver. In my case, it was silver at the time with my lawnmower boy money. But it was the expectation, the understanding that, oh my gosh, inflation's out of control. These headlines, these nightmare headlines about how inflation was going to the moon and we weren't going to, it didn't seem possible. The Fed couldn't control it, pre-Volcker. It seemed out of control. Nobody knew what was going on. So that fear drove a lot of people into gold and silver who wouldn't otherwise. So it was very strongly the expectation, not just the reality. Mm-hmm. If you look at just the numbers and correlate them, you'll get a different thing than if you correlate the expectation. And that's, broadly speaking, I think that makes perfect sense. I've often described gold as a fear barometer. Right? People want to look at the supply and demand, how much is coming out of the mines and how much is being made into jewelry and all that stuff. And I think that's an erroneous way to try to predict the price of gold. Because as you and I know, most of the gold that's ever been mined is sitting around in refined form in vaults somewhere or another. So the potential supply can always completely swamp any industrial or jewelry or other demand out there if suddenly everybody decided to sell. So the psychology is paramount here. The keeps it in balance is how much people fear. And that's why I see it as a fear barometer, and that's why gold is more closely related to expectations in terms of big price moves. Sorry, one more thing real quick.
For sure.
But if you look at the big picture, like, 10 year, whatever year, look at the biggest picture that we can of the new monetary regime since 1971, when the gold standard was finally, completely killed. Gold's gone from 35 bucks an ounce to here we are above 1900. And the dollar's purchasing power has gone from whatever it was to whatever it is now, but quite the opposite. So if you look at that biggest picture, I think you can still see that gold does actually correlate long term with inflation. The destruction of the purchasing value of the dollar is captured in the price of gold today. So I'm not here to debate the philosophy of the price discovery mechanism. What I'm saying, and what you've just shown on those charts, and if you look at the averages, look at gold. Gold over $1,900. That's a great price. But the average over the last year is around $1,840. That's a fantastic gold price. Most of the gold mines in operation now were designed at the $1,300 price or even lower, and they're now operating based on price assumptions that are way lower than what we're realizing now. And this isn't a peak. Okay, 1,900 right now is a short-term peak. But the 1840 price I'm talking about, that's a year-long average. These guys make tons of money at that price. And 2450 for silver, people get all upset about silver not being higher. But the silver miners, the better ones, they learned how to make money at less than $20 silver. And for it to average over 24 bucks for a year, that's a fantastic silver price for the business. Never mind, the philosophy. If the goal is to invest in good businesses that can see share price appreciation, if we're right about the metals prices going higher, then this gives us a tool. Look at who was able to make money over the last year, COVID and all. If they could survive all the ups and downs of 2020, that's a great tool for stock picking. And those companies will be poised to do even better if we're right about gold going higher. I do expect gold to head up towards $3,000 before all is said and done, maybe higher. I expect silver over 150, maybe closer to 200 before all is said and done. But those are peaks. The longer term average price, we can make money there. And we can see which companies can make money there. We can see which exploration and development projects can make money where we are now.